Hello and welcome to this month's edition of Markets Unwrapped with me, Craig Melling, Director of Investment. And today I'm joined by Mark Lane, Head of Active Solutions here at Progeny Asset Management. We've seen a lot in the press over the past 2.5 days around the conflicts in the Middle East. So in this edition, we'll be talking around just what's been happening since those attacks started at the weekend, how we're positioned and what we see going forward. So Mark, let's look at what's happened over the past 2.5 days.
Well, I think you're right to timestamp it, Craig, because this is a very fluid and unpredictable situation by its very nature. So we're here today, lunchtime on Wednesday, and we've seen a huge amount of volatility in markets. The reaction that we've seen in markets is indicative of the fact that people weren't necessarily expecting this, even though there was a significant build-up of military presence from the US in the Middle East.
And I think the key thing here is looking at the immediate reactions to the conflicts we've seen. We've seen higher oil prices. So oil price was up 9% on the day on Monday. We've seen excess volatility in fixed interest and equity markets. In fact, they've been moving in tandem, something you and I have been worried about could happen for some time, and we've positioned portfolios accordingly for that. But I think it's that volatility, isn't it? There's lots of focus on the Strait of Hormuz right now, what the impacts of that effectively being closed is, and it's the real focus is on oil and energy prices, and just how long this conflict lasts will determine how far reached the ramifications are for markets. I think as we sit here today, I think there's lots of talk about the duration of this conflict potentially being 4 weeks or so, and that's kind of what the market has been priced in. But anything longer than that, we could see severe ramifications, especially to inflation.
Well, indeed. And that time frame has already shifted because originally I think the market was expecting this might last a couple of days. But yesterday, I think the market came to the realization that actually it was going to be more the time frame that you've identified. And we've seen some very strange moves. So on Monday, gold performed very strongly. It was up sort of 4%. Yesterday, it was down 3.5%. This morning, gold is up again. So I think we're actually starting to see some quite liquidity-driven market moves because people are just offside. And the consensus trade this year has been to be long emerging market equities and short the dollar. And we've seen both of those trades unwind so far this year. But to your point, we have been talking about the potential for geopolitical events to be inflationary. We've talked about the fact that our base case for interest rates and inflation is not what it was pre-COVID. And that if you're above target for interest rates, and if inflation is in the 2.5% to 3% ballpark range, then when you do get these geopolitical events, which do seem to be more likely than they were certainly 5 or 10 years ago, given the sort of the populist wave that we're witnessing, then they're going to be inflationary or increase inflation expectations. And to the point that we've been discussing over recent months and quarters, that's going to have the potential to drive equities and bonds in the same direction, which is obviously not a favorable outcome for portfolio values.
I think what's really interesting is the speed of news flow and the speed of investor sentiment, how it's changing. You've just highlighted there, in the past 3 days, we've seen almost 3 different narratives as people adjust to the news flow. I think what's really become paramount and clear is long-term objectives are changing. The interest rates, the forecast for interest rates, lots of central banks were forecasting in 2% cuts. Looks like all cuts for this year have already been taken out of forecasts. It's the power of 2 this year. We're in the second year of Trump's term. But also 2% inflation was forecast across the board. And again, people are now looking at, are we going to see an inflation environment? Could we see interest rates go up?
Well, we could do. I mean, I thought that the expectations for inflation and interest rates was a little bit too positive in the sense that they were going to come down to a reasonable extent. The market already seemed to have been pricing in some interest rate cuts this year. We saw a reasonable return to fixed income in February. And of course, all of a sudden, as you've just highlighted, all of those expectations have really been upended. So the market is now genuinely questioning whether or not the next move in interest rates is up or down. And that, to your point, will very much come back to the duration of this war. If we see escalation, et cetera, then that's definitely has the potential. But I mean, we were just discussing off camera how, obviously the situation within Iran and in the Middle East at the moment is very fluid. It's very difficult to predict, but it is part of a longer term trend that we've been witnessing and that we've been talking about, where we just think at the margin, these events, they're inflationary. We're seeing deglobalization, shortening of supply chains, less trust globally amongst developed market nations and emerging market nations too, less use of the institutions like the UN. And therefore, these to me really provide a bit of a tailwind for higher inflationary numbers, which is why we've been positioned in the way that we have been. Our central case this year was a strong economic growth environment, but at the margin where we saw the risk was a higher inflationary environment, partly predicated on the potential for geopolitical events to be inflationary. So to your point, yeah, the market really is questioning which way next. And we've seen in the last couple of days, nominal bonds really struggle. Inflation-linked bonds have performed much better. You've obviously wanted to own shorter duration assets. And of course, the last time that you were on this markets update, you were talking about the tactical asset allocation updates where we reduced our fixed income exposure, we shortened duration, and of course we have the overweight alternatives.
And I think that's key, isn't it? I think if we talk about one of our big themes for this year is diversifying the diversifiers, looking at portfolios, positioning them for bouts of volatility, any geopolitical tensions, and changing environments and interest rates and inflation. And I think for us, we have to look through the noise. We're not trivializing what is going on in the conflict, but as investors, we have to plan for the longer term. And portfolios, as you say, Mark, across the piece, whether it be our active solutions or our private wealth solutions, they've been positioned underweight to fixed interest and in the short duration area of the market. So we're kind of where we need to be in fixed interest to benefit from what's going on right now. We're not getting too much hurt by our fixed interest exposure, but ultimately we'd also been diversifying into alternatives. And that's been a big theme for us over the last 6 to 12 months. And we think that's going to stand us in good stead right now to just have a defensive ballast to portfolios.
One of the things that I've learned over the years is that in the teeth of an event like this, it is very difficult to maneuver portfolios with any prescience or time markets when you're seeing big intraday moves. So clearly over coming weeks, we will consider tactically how we can insulate or benefit portfolios depending on how the situation evolves. But crucially, and of course we didn't predict Iran and the US going to war, but crucially we've come into this market event with a portfolio which is, to your statement, diversified. Our diversifiers are diversified. We thought at the margins these events could be inflationary and were unfortunately more likely than we would otherwise like. So we've come into the event positioned in a manner which does help to promote portfolio resiliency.
So I mean, in short, we've been positioned quite cautiously. We are continuing to monitor the situations which appear to be extremely fluid. We do, and to give the viewers some comfort, we have a number of funds and stocks and scenarios on our watch list, which the team and the wider team is focused on every day to look for any opportunities or any changes that might need to be made, depending on how long these conflicts and tensions last. But right now, we are really focused on that long-term defensive nature of the portfolio and reacting to tangible information, not speculation, and most importantly, in environments like this, not working on emotion. Focusing and taking emotion out of what we do and how to invest, it certainly in times like this is paramount, isn't it?
Absolutely, that's a great summary. It's focusing on tangible things and trying to remove the emotion. And then when we make decisions, we're making decisions for the right reasons and not because we're speculating.
And I think finally, for any of the viewers that are impacted by the conflicts or have people in any of the territories in the Middle East, we wish everyone well and hope they are safe. And as always, if there is any questions around portfolios or what's going on in the markets, the Progeny Asset Management team are there to help, to talk and demystify whatever is going on. So thank you everybody for watching, and we look forward to seeing you in the next edition of Markets Unwrapped.